Not sure whether to invest in stocks or bonds? Let's break it down in plain English with real examples to show how each one works. Welcome. In this video, we're diving into the world of stocks and bonds. We'll cover the key differences between them, how they typically perform, when you might consider using each one in your investment strategy. By the end, you'll have a clearer picture of how to build a balanced portfolio. First up, stocks. What exactly is a stock? Think of it as ownership in a company. When you buy a share of stock, you're buying a tiny piece of that business. For example, let's say you buy Apple stock. You now own a small portion of Apple. As a shareholder, you can potentially profit in two ways. One, through the company's growth. If Apple does well and its stock price goes up, you can sell your shares for a profit. And two, some companies like Apple pay dividends, which are regular cash payments to shareholders. Now, let's talk about bonds. Unlike stocks, a bond isn't ownership. Instead, it's a loan you're making to a government or a company. They're borrowing money from you. In return for lending your money, they promise to pay you back a fixed amount of interest over a specific period. For example, you might buy a 10-year U.S. Treasury bond. This is essentially lending money to the U.S. government for 10 years, and they'll pay you interest, say around 4% per year, until the bond matures.